Again, thank you all for joining. I'm going to hand things off to our first expert of this lunch hour, and that's Conor McKenzie from Downs Rachlin and Martin.
Thanks, Austin. Hi, everybody. Glad to be speaking with you all today. So I've been practicing tax for about 15 years. I joined DRM's business law group about a year ago, and my focus is business tax issues for businesses and business owners, including state and federal income taxes, for corporations, partnerships, individuals, as well as sales and use tax and other indirect taxes. And Steve, you want to go next?
Sure. I'm Steve Julian. I am a tax partner at Gallagher Flynn. Been with the firm for about 23 years now, and I work primarily with closely held businesses, really in the real estate, manufacturing, hospitality area. And then a lot of my work extends into high net worth individuals, planning, estate and the tax planning.
And my name is Alena Fitzgerald. I'm also a tax partner at Gallagher Flynn. I also tend to focus the majority of my work with closely held businesses, primarily based in Vermont and New Hampshire, and their owners. I'm also a Vermonter myself, pretty much grown up in the state, left for a while, but came back. So kind of this constituent base is near and dear to my heart. I want to make sure people are informed about how these wide sweeping changes or things made permanent impact their business and arm them with the ability to plan and make good informed decisions.
So welcome everybody again. Good afternoon. And we're going to go through the One Big Beautiful Bill Act, which we've been talking about what we name it. And I think we've all gone to OB3 because that's just much easier. So we're going to go through the provisions that we feel are most impactful to the constituents we have on the call, and we'll focus on those. But we'll also kind of go over all the other pieces of the bill as well. And there'll be plenty of information provided that you can also always look back to for reference in the slides if there's other questions that come up, or feel free to reach out to us as our contact information will also be provided. So what's in this bill? Basically, the bill contained $4.5 trillion of tax reductions, essentially. And overall, the net bill is about $3.7 trillion because there's some income offsets. But the biggest piece of this bill is really the extension of the lower individual income tax rates and the doubling of the standard deduction. There's many other pieces involved in here. That we see often, which we'll talk about, is the qualified business deduction, which is the 20% pass-through deduction, as well as items related to bonus depreciation, and also we also have the R&D expensing that is allowed again now too, and those also have some major impacts on taxes. The main revenue raisers that were involved here were really spending cuts, mostly to Medicare and some other food programs, specifically SNAP. So that's where a lot of the offset comes. But the majority of the bill really is tax reductions. And then Alena's going to run through the context.
I just wanted to arm taxpayers with the context of how these recent bills were passed. It's kind of important in how we got here. So the Tax Cuts and Jobs Act of 2017, which is years ago at this point, is kind of really impactful in what the OB3 bill did, because the OB3 bill made a lot of the things from the Tax Cuts and Jobs Act permanent. It's important to note that both the Tax Cuts and Jobs Act and OB3 were passed via budget reconciliation. And this process is important just at a high level because it allows a simple majority. That's why it's used. But the reason it's important is because it needs to accomplish certain budget goals. And the major theme that we saw as tax professionals and how it impacts businesses in the Tax Cuts and Jobs Act is that in order for the bill to kind of meet its budget goals, they had a lot of provisions that needed to sunset. And I think that's what we were running into when we saw R&D kind of all of a sudden not be fully expensable anymore, or bonus depreciation starting to sunset. On the other end, as Steve alluded to with OB3, the cuts were in other areas. They were in energy, healthcare, other areas. So wanted that context. So we'll make reference to a lot of things that were made permanent. This is a pretty comprehensive list, but a lot of what the OB3 did was make things from the Tax Cuts and Jobs Act permanent. So it's not a big change in how we've been operating for the past several years. It's just that it's now permanent until a new law is passed. This is the kind of comprehensive list, and we're going to go through things in detail as well.
So we want to start by talking about some of the impactful business provisions that were in the bill. And, a few of the big things that are in there is regarding bonus depreciation, Section 179, and the changes to R&D. So we'll talk a little bit about bonus depreciation. It's been around for a long time now, over 20 years, essentially. And it has changed based on, various terms and so forth. But most recently, we're from the TCJA, we were under a provision where bonus depreciation was being phased out over a period of time. And OB3 actually changed that phase out and brought us back to 100% bonus depreciation election expensing, essentially. So any acquisitions made after January 19th, 2025 now qualify for the 100% bonus depreciation again. And what is more interesting in the bonus depreciation is they created a new group of bonus depreciation property called qualified production property, which we'll see in the next couple slides. So qualified production property is different because what this allows you to do is take bonus depreciation on real property, specifically real property that is for mainly manufacturing companies, but for your manufacturing space. So this is really beneficial because it takes assets that you would normally depreciate over a 39-year period, and basically allows you to expense it in the year that the property is placed in service. So again, there's rules and definitions around what qualified production property is, and again, there may be questions that come up specifically what does qualify, but in general, we're looking at manufacturing space that qualifies, and manufacturing buildings. Some things that they talk about that specifically do not qualify is your office space, your administrative space, potentially some warehousing space that is used on the shipping side of finished goods, because that's considered post-manufacturing part of the process. And also there's an exception for leases. So if you build a property and lease it to a manufacturer, the lessor of the property does not get to take this bonus depreciation. Only the actual operating company, so the manufacturer themselves, if they build and incur this cost, will they be able to take the bonus depreciation on that property. And we run into some issues with this because, a pretty common tax strategy is that owners of a business will also own the real estate, but they'll hold them in two separate entities. And the real estate entity will rent the property to the business entity. And in this situation, technically, if you continue to put the property in that real estate entity, it may not qualify for the QPP bonus depreciation deduction. So there may be some workarounds there to make sure you do get that bonus depreciation by having the operating company complete those additions, or either, and then you could do a land lease with the real estate company, or set up possibly another structure. So it's not unavailable to those types of structures, but you just have to work a little bit more to make sure you do get that deduction. And then, so Section 179 was also bumped up as part of the OB3 bill. Again, the rules around 179 are pretty much the same. And now we're just dealing with higher phase outs where you can expense up to $3 million per year through the Section 179 deduction, again, depending on how much tangible personal property you place in service in a year. Basically, once you get to $4 million, the threshold or the amount of 179 you can take starts to phase down. So then let's forward along a little bit to the case study. A few more slides. Yeah. So just wanted to kind of look through a simple case study here of, what would happen in the situation a business purchases $3 million of tangible personal property, in a year. And generally, this type of property would qualify for both Section 179 expense and bonus depreciation. In both cases, with 179 and bonus depreciation, you can expense the full amount in the given year because of the 100% bonus depreciation rules. But there are some differences, essentially. And one of the main differences to think about is, what is the state impact of the 179 versus bonus? Most states still allow 179 deductions. We haven't seen if they're going to make any changes with the new higher limits now. But on the other side, most states don't allow bonus depreciation. So if you can take the 179 deduction, it could produce a better state impact as far as getting the deduction sooner. The other item to keep in mind too is that bonus depreciation can actually create a taxable loss. 179 cannot. It's going to be limited to the taxable income of the business. So if you have 179 in excess of your taxable income before the deduction, you can reduce it to zero, and then any remainder can get carried forward, or you can elect out so that you get the right amount of 179. So those are some key things to consider when you're looking at which way you choose to go as far as trying to get the best benefit for your capital expenditures. And then again, as we talked about the manufacturing business and the building, again, this is the QPP. So again, the key things to consider is, does it qualify as manufacturing property essentially under the definition? And do you have to kind of carve out certain spaces? Because a lot of times there'll be dual use property. So you'll have your manufacturing space and then you'll also have some office space and things like that. So you have to take a look to see what portion of the structure that you're putting up does qualify for the QPP 100% bonus depreciation.
So another kind of long-awaited change that the OB3 made happen was going back to being able to immediately expense domestic research and experimental, better known as research and development costs. And this had bipartisan support ever since 2022 to kind of get this fixed. It was never actually thought by tax professionals that it would happen, that we would have to go to this scenario where any company, and we see this pretty broadly, manufacturers take R&D credits, all kinds of our kind of across industries take R&D credits. And basically what this did was have to or created a scenario where you could no longer immediately expense those costs and get a credit. You had to capitalize and amortize them. So it was a timing benefit, but it was extremely impactful. Under the OB3 kind of, like I said, brought back the ability to immediately expense domestic. It left foreign R&D at having to be capitalized and amortized over 15 years. So that's now permanent. So again, all in my entire kind of practicing history before 2022, you were able to immediately expense your research and development costs. And then for 2 years, you had to capitalize them. And now we have a fix, and that fix looks different depending on if you're a small taxpayer or not. And the definition of a small taxpayer is if your gross receipts for the average 3 years in 2025 are less than 31 million. And so if you're over that threshold, you basically get to release all of your costs either in 2025 or over 2 years in 2025 and 2026. So we have clients that are planning on some large deductions and that don't have an option for retroactive treatment. However, the bill was passed with the ability to kind of fix this issue for small taxpayers retroactively. And we got recent guidance that can be done on a timely filed 2024 return. But it does require kind of an all or nothing approach. So if you want to immediately expense your costs on a timely filed return, you do have to amend all years that were impacted. So again, one more slide, Austin. We kind of get to this point where we have some options, and the ability to recover these costs depends on your business size as defined by gross receipts. One more slide. One more. I think I'm going to jump to the case study. So here, or one back, sorry. So I wanted to kind of go through some key considerations in terms of how you choose to apply this new guidance, because we have found in our practice that it really depends on the sum of all of these factors, and we've gotten to a really different result with almost every single taxpayer. So are you an eligible small business? What is your year end? Are you a calendar year end or are you a fiscal year end? What are your cash needs? How long is the IRS gonna take to process an amended return? Is that gonna get, with our crystal ball, is that gonna get processed sooner than waiting and filing on a 2025 return? What is your entity type? This really matters. Are you a C corporation? Are you an S corporation? Are you a partnership that isn't eligible to amend your returns under certain kind of audit regimes? What is the state impact? How impactful is that? So like I said, every taxpayer has a unique set of facts and circumstances. On the next slide, I'll go through a few just so you can start to see yourself in where we've landed with some specific fact patterns. So all of these are qualified small business taxpayers, and that's important because that's the scenario where you have the most options. Otherwise, if you're large, you either have to take all of your remaining unamortized costs in 2025 or take them 50-50 in 2025 and 2026. So here's the scenario: a small business taxpayer is a fiscal year end with significant R&D. And so I'm talking, $5 million of qualified R&D expenses, about $200,000 of credits being taken. So quite a large amount. And this scenario, C corporation. So that matters in terms of whether we choose to amend, because if you amend, you have to amend entity and individuals if you're a pass-through. So after the analysis, we felt like it was best to go ahead and amend the open year and file timely without having to capitalize R&D in a timely filed return, which again, we just got guidance to do. And then that lets us stop paying kind of estimates based on this higher amount as well. So there was a compelling reason there to go ahead and amend prior year returns and not capitalize R&D on a current year return. Separate fact pattern, a calendar year end manufacturer, a substantial amount of costs that were eligible for R&D, resulting in $3 million of unamortized costs that would release in 2025. 3 years of returns would have, amended returns would have been required, or a superseding return, because we filed timely. And so in this scenario, we decided to plan on the deduction in 2025 because we felt like that was going to result in the quickest cash flow benefit for this taxpayer. So I just wanted to kind of point out a few different scenarios and how we landed in very different conclusions depending on the facts and circumstances and the cash needs. Just highlighting here key advantages of being a qualified small business under OB3. You have options in terms of how you retroactively apply 174 or changes in the R&D costs. Steve will talk about next. You're not subject to 163J or interest limitations. And it didn't change, but just a reminder, you have different accounting methods that you can elect. So all those things are just really important to highlight if you are a qualified small business under our current tax regime.
Yeah. So some other business provisions that are in the OB3 that will impact you, but not as significantly maybe as some of the other ones we just mentioned. The qualified, or I'm sorry, the deduction for business interest had existed and still exists, but they made this more favorable now, and they went back to what we call an EBITDA standard, but we'll look at a slide later that shows EBITDA is a book term. It's really a tax calculation, a taxable income calculation. And then we also got a permanent extension of the qualified business income deduction, which is the 20% deduction for pass-through entities. And Connor's actually going to make reference to this when he talks in future slides about choice of entity and how this comes into play as well. And then they also made no changes to the pass-through entity tax elections, which this was a workaround that many states did to give taxpayers the benefit of paying their state and local income taxes effectively went away when they reduced the itemized deduction down to $10,000. So if we look a little bit more at the interest expense limitation, this did come into play when the TCJA was passed. However, it got delayed for a couple years, and then there was in the beginning, the calculation was you calculate your taxable income and then you adjust it to add back your depreciation, amortization, and interest expense. And then you take 30% of that, and that's how much business interest expense you could deduct. Unfortunately, 2 years into that, it changed where you could no longer add back your depreciation and amortization. So it created a situation where some taxpayers who are more highly leveraged than others and rely more on debt and have a higher interest expense were in a situation where a lot of that interest expense wasn't currently deductible and had to be carried forward to future years. But OB3 came back and said, all right, we'll let you basically add back your depreciation and amortization again, which helps out a lot of businesses. And if we look on the next slide, we actually kind of have the formula of, oh, one more slide, I guess. One more, Austin. There we go. This has the formula of how you do this calculation. And as I mentioned, EBITDA is the book term, but basically we are starting with taxable income, adding back our interest expense, our taxes, depreciation, amortization, and then we get to our limitation. One other thing to mention here is that, again, there are exceptions to this rule, as Alena mentioned. If you're a small business taxpayer, generally you're not subject to these interest limitations. There's also a special election for real estate companies where you can make an election not to have the interest expense deduction limitations apply. You do have to give some things back in that situation. You have to depreciate your property over a little bit longer period of time, and there's some limitations on bonus depreciation depending on what type of real estate you're dealing with. And then quickly, the qualified business deduction 199A. Basically, there was really no change to this. There was some small changes and some thresholds for taxpayers where they may have been phased out in certain situations for certain types of income. And then there's also a minimum QBI deduction that they put in place as well, but I think it's only $400. So that wasn't a major impact. But overall, the main takeaway here is that the deduction still exists. It stayed the same, and now it's permanent. Which helps us a lot with our taxpayers in planning on what type of entity that might suit them best. Because when you're comparing pass-through entities to corporate entities, you have to compare, what the tax rates are and so forth. And again, Connor will talk a lot more about that in detail. So, okay. And then finally, one other item in there. Qualified small business stock. A lot of you may have heard this as called 1202 stock. And again, this comes into play when you're looking at your choice of entity because this only applies to C Corps. And again, this is a provision that's been around for a long time and has seen various changes throughout the years. Most recently, before OB3, if you had qualified small business stock, which was essentially defined as a business that had $50 million or less than assets, again, was a C Corp, and the stock you received was issued in exchange for cash, services, or property, meaning you couldn't buy it from somebody else, it had to be issued directly from the company, then you could potentially, if you held that stock for 5 years, you could potentially exclude up to $15 million of capital gain when you sold that stock. So they made some changes to this in OB3. One, they're created a phase out schedule so that you don't have to hold it for 5 years now. You can hold it for 3 or 4 years and get 50% or 75% of the exclusion. And they also increased the definition of a small business to assets $75 million and under. Now, when you're looking at whether a company is a small business, there's a lot of other pieces to that definition. It's not just that asset threshold, but that's the main one to look at. There's certain types of businesses that don't qualify. Generally, usually service type businesses don't qualify. And there's other items that you have to look at to make sure that the stock is indeed qualified small business stock. But it is a very beneficial provision for people who want to invest into new companies, essentially. And it helps those companies get financing, essentially, to move forward. Okay. Now I hand it off to
Great.
Connor.
Yeah. And so thanks. Yeah, that's a perfect segue into this section of the presentation where we're going to talk about choice of entity and how the Tax Cuts and Jobs Act, or TCJA, of 2017, as we mentioned, OB3, a lot of what OB3 did was made these provisions permanent, but how in tandem, the TCJA and the OB3 really made choice of entity more important than ever from a tax perspective. So as we can see from this first slide, it matters. The reason entity choice matters is it impacts how much tax you and your business pay. One key consideration is when you can access profits. Sometimes if you're planning on distributing all profits every year, then sometimes flow through entities, that's an advantage there. But if you're planning to distribute some and then reinvest a lot of the profits, and then sometimes that can make a C corporation more attractive. And then you've also got to think about growth, your time horizon, and then if you're already thinking about your exit strategy, if you're planning, if you want to, the plan going in is to sell the business after a given period of time, then that could impact your decision as well. So next slide. So stepping back a bit, if we think about the landscape before the TCJA and the OB3, the corporate tax rate used to be 35%. So they had a dramatic rate cut to 21% with the TCJA, which actually was made permanent as of 2017. But many of these other provisions were set to expire. Individual rate was reduced to 37%. And with 2017, they had this new deduction for QBI under Section 199A that Steve just talked about a bit. And the rationale from the legislative history for this was essentially that the committee, the House committee report noted that it believed that the corporate rate reduction, the intent was to lower business taxes, and they said this is great for corporations, but in our view, this doesn't completely address the income taxes imposed on businesses because so many are operated through pass-through entities. and sole proprietorship. So what they did was they enacted QBI deduction, which is basically a 20% deduction from income, and it applies to flow-through entities and sole proprietorships, as noted. And it applies to certain industries and not to others. In my view, somewhat arbitrary, but so that's why this makes the decision more impactful and more important to carefully consider it, because you can't just say, okay, I'm a flow-through entity, I'm going to get the QBI deduction. You have to look at what type of industry you're in and what your other details about your business to make sure you're going to qualify for it. Then similarly with the 1202 qualified small business stock deduction, which OB3 made, it was already very generous provision, and OB3 essentially supercharged it, made it even more generous by allowing a deduction after only 3 years rather than 5. A little background there. So the 1202 deduction was originally enacted under the Clinton administration, and it probably didn't get as much attention at the time because the corporate rates were 35%. So, even though it was very attractive in that if you qualify for this, you could get 100%, when you go and you sell the stock of your business, you could get up to 100% capital gain exclusion from the sale. I mean, that's a huge benefit, but maybe still didn't make corporations as attractive as you might otherwise think, because there's the 35% tax rate at the time, and corporations are subject to 2 layers of tax. So you're taxed on the corporation's income, and then when you distribute it out, you pay tax on the dividends. So even with the 1202 deduction, a lot of businesses were still choosing flow-through entities because of the 2 layers of tax essentially. So if we go on to the next slide. Let's see here, what do we have for the next one? So this is just a comparison of the rates kind of before and after the TCJ and OB3. If you see that, so pre-2017 are the first two bars, and you can see these are intended to take into account the 2 layers of tax. So pre-2017 C Corp, you can see when you take into account the 35% tax rate plus the tax on dividends, you're up around the 50% mark, whereas a flow-through entity with a single layer of tax was closer to 40%. Then if you move after TCJA, if you assume QBI applies, then the effective rate on a partnership is quite a bit lower than C Corp, even with the reduced rates, down to 21%. Because of the 2 layers of taxation. If you assume you don't get the QBI, the C Corp and the flow-through taxation, when you take into account all layers of tax, are within striking distance of each other. Let's go to the next slide. So first and foremost, I think it's important to mention that you don't ever want to let the tax tail wag the dog. In other words, so tax is important, but it's one consideration. You've got to think about other business and practical considerations that may weigh in favor of one entity type or another. And another thing to note at the outset is that the legal form of organization does not always dictate the tax entity type in the eyes of the IRS. So just to give you a few quick examples, legal corporations are generally always a corporation for tax purposes. So, if you have Inc. next to your name, it's kind of a shorthand. That means you're a legal corporation, and that means you're going to have to be a corporation for federal income tax purposes unless you convert to an LLC or some other legal entity type. LLCs, on the other hand, limited liability companies, which are fairly ubiquitous these days, they can be partnerships, sole proprietorships, C corporations, or even S corporations for tax purposes. Partnerships for tax purposes require at least 2 owners. So regardless of your legal form or organization, you need to have at least 2 owners to be a partnership. Under the Internal Revenue Code. And the other interesting thing is a tax partnership doesn't even need to be legally organized. 2 individuals that start a business venture together and have even a minimal amount of financial activity can be deemed to be a partnership for tax purposes, even if they never formed a legal partnership. One of the considerations with choice of entity is liability, limited liability protection. So, generally we're going to advise that, you don't want to do this if you want to have a partnership. You don't want to just fall into it, and you want to organize some type of legal entity that's going to provide liability protection, such as, a limited partnership or an LLC. So then if we go back to tax purposes, thinking about this through more of a tax lens, I think, maybe what we do is go to the quick comparison chart. Yeah, there we are. So partnerships offer immense flexibility, really, in how to structure an economic deal. So if you've got a business, with various investors, and you have maybe some are going to be more active in the business and some are providing capital, and you've got an economic deal that involves complicated distribution waterfalls, and maybe one partner wants more depreciation and one wants less, and it really offers you a lot of flexibility. And the tax code actually allows for a really, really wide range of economic deals to be respected for tax purposes. So if that's your situation, that could weigh in favor of a partnership. Whereas an S corporation, they have a single class of stock rule that basically what that means is, all shares of stock have to have equal rights to operating profits and profits on distributions. So a little less flexibility there for, to accommodate a complicated economic deal. I think the one thing to keep in mind with partnerships, and Steve and Alena could probably attest to this, is that the more complicated you get in structuring the economic deal and really using everything the partnership form allows you in terms of having complicated allocations and distribution waterfalls, it's going to make your financial and tax accounting more complex, and it's going to make your tax compliance more complex, and it's going to become ever the more important to make sure that you have you're working with an expert tax accountant or tax advisor to make sure you're computing everything correctly. Partnerships and corporations allow more flexibility in who the ownership could be. Essentially they can be anyone. Partnerships and corporations, anyone could be a partner or a shareholder, whereas S corporations are more limited. It's got to be domestic, basically it's domestic individuals and certain trusts in the states, and tax exempt entities. And there can be differences for between the entities for estate and succession planning. Just to give one quick example, if a partnership business, if the partner passes away, the assets can get a step up basis of death, whereas an S corporation, the assets inside the corporation would get a step up. And that's just one factor. There can be a lot of factors that weigh in favor of one or the other. There's the Medicare tax to think about. It applies to certain types of income and not others. So you have to take all these things into account. Then one thing to note, I think, as we get to from this slide and forward, is just that these slides are going to refer to, as a comparison for the sake of simplicity, but partnerships and corporations. But most of the discussion in the following slides and the rest of this section applicable to partnerships is going to apply equally to S corporations as well, because they're both flow-through entities and they're generally subject to the same tax rates. And I'll call out some, key differences when they're apparent. Moving on to the next slide. As you can see from this, and you can look at this in more detail at home, we'll be sending out these slides, but this shows tax scenarios for businesses that distribute profits annually. And when you're, I think the key takeaway here is that, generally, if you're distributing all profits annually, the C corporation, which is the orange bar, is going to have a higher effective tax rate. And again, that's during operating, and then there can be different considerations on exit, for example, when you sell the business. And I think another key thing to call out here is that, just showing why this is it's an important and kind of complicated decision, and important to, spend some time with your tax advisor and thinking about what entity type is right for you, because you got to think about, okay, is the Medicare tax going to apply? Do I potentially, qualify for the 20% QBI 199A deduction? That's a nice benefit. So it's important to understand if you qualify or not. And then another question is, are you planning to distribute all the income annually, or are you planning to do a lot of reinvesting into the business? And all of these will weigh into, how much tax you pay overall. Next slide, please. So I think in conclusion, there's really no, as the slide says, there's no one size fits all answer. I think, shorthand is if you're distributing profits annually, often, just from a pure tax rate perspective, partnerships or S corporations can have advantages there. But if you're planning on doing a lot of reinvestment of profits, C corporation can be advantageous, because if you're not distributing out the profits, you're only paying one layer of tax. You just pay 21% at the federal level. And the other key advantage is the 1202 qualified small business stock deduction, which again can provide up to 100. And you go and sell the stock, you get a complete, and you make, say, a $20 million gain on the sale between a couple of partners. That could potentially be 100% excluded from tax. There's a lot of requirements to be met there, but it only applies to C corporations. It doesn't apply to S corporations. It is possible, and it's generally not something that you just fall into. It's something that you're going to want to be aware of and kind of structure your business around to make sure you qualify. But one thing to keep in mind about the 1202 is that it does require business owners to have a little bit of a crystal ball, in that they know that, they're planning to sell the business, and also that they're likely going to be able to sell the stock. In the case of business sales, a lot of times buyers would prefer to buy assets for various reasons, both from limiting legal liability and also getting a step up in basis. To get the full benefit of the 1202, you need to be able to sell the stock. So that can be a good fit for your industry, and sometimes it's not a great fit. So again, careful planning is more important than ever after TCJ and OB3. And I will hand it back to who's next? Steve or Alena?
Steve.
Great.
Yep, that would be me. So also wanted to just quickly mention the employer-provided childcare credit. This has, again, existed for a while, but OB3 basically supercharged it. It went from $150,000 credit to a $500,000 credit, and possibly a $600,000 credit in some cases with eligible small businesses. Basically, this credit is for employers that provide either like a child care center or child care services to their employees, and they can get a credit, which used to be 25% of those costs, and now it's up to 40% of those costs. So this can provide a significant benefit for a business with a credit that can offset taxes dollar for dollar. And also in the case of small businesses, if they can't afford this on their own, they can potentially pool with other small businesses to provide this benefit to their employees. So it's something to certainly take a look at, and has been, a topic of discussion of, finding qualified childcare around the state, and really in a lot of other places too. So, and then Alena is gonna go forward, talk about some other business items.
Yeah, and so the goal of us running through just at a high level some other things that changed is just so that everyone can see themselves in this law and at least be aware that they might need to look further into it if these apply to them. They're less common or less impactful, but they're changing. So we just want to highlight them quickly. So charitable contributions, the ability to deduct isn't going away. It's just instituting a floor and some different limitations. Excess business losses, again, made permanent, but this is an important consideration given all the changes. This basically added another layer of loss limitations a long time ago, 2017, was repealed for a little bit and then came back. But important to kind of just remember and consider that if we generate a giant loss, we might not be able to use it all at the individual level. There were some changes to the statutes of limitations around employee retention credits. Those are mostly behind us, but we are still seeing activity with those being audited. So just a reminder that some statute of limitations and fines and penalties changed there. The paid family and medical leave credit made permanent. Employer provided meals still allowable as a deduction. At 50%. Again, there was talk about that going away. The CHIPS credit, if you're involved in manufacturing in the semiconductor space, got more lucrative starting in 2025, went to 35%. It didn't extend the expiration date, but it did make it more lucrative. And again, we have some clients that have seen some pretty nice benefits in this space. You don't have to be 100% manufacturing semiconductors. You can be in the supply chain. So low income housing credits and new markets tax credits both made permanent, kind of important for planning if you're in this space. And these are complicated areas. And then dependent care assistance programs kind of made a little bit more lucrative, and employer student loan exclusions, again, made permanent, made a little bit more lucrative. Just want people to be aware of the things that are out there, just to kind of highlight and ring to know that you should look. Along those same lines, some change in thresholds for 1099 reporting for employers. For the first time in my career, you know, the minimum at which you have to issue a 1099 is going to 2,000. That's kind of exciting, from 600. And same thing, they carved back some credit card reporting. So again, more information here, but there was a lot in the bill. So we want to highlight for people to be able to see themselves in it, and with the intention of being able to look back or ask more questions of your tax advisor.
And similar to that, I also just want to highlight some of the individual provisions that were in the bill. Again, these first two items here, the lowered individual income tax rates and the double of the standard deductions, aren't new, but they were made permanent by the bill. And as we discussed early on, these are the two most expensive provisions in the bill. And then under other individual provisions, now we've got an enhanced deduction for seniors. So they get an extra $6,000 basically exemption for their income. And some other items that were talked about quite a bit and do provide a benefit, but probably fell short of where a lot of people thought they were going to be, is the deductions on tip income and overtime pay. Both of these are going to be deductions that are taken at the individual tax level. They'll need some information from their employers on, you know, what the qualified tip income or overtime pay is. And then there's some phase outs and thresholds that apply when the individuals are trying to take these deductions. And one specific thing to note on the overtime pay, is that the deduction is not for the full amount of the wage that you get paid for overtime. It's only for the difference between your regular wage rate and the overtime rate. So, you know, if you're getting paid $20 an hour and your overtime rate is $30 an hour, the qualified overtime pay is only that $10 difference per hour, not the full 30 for the overtime. So I think that was confusing to a lot of people, and they thought they would get the full deduction for the full overtime rate of the 30. So wanted to mention that. And then one other quick thing, alternative minimum tax. There's an exemption there that was, again, made permanent, and this keeps a lot of people out of the AMT. And also, we saw an increase in our SALT cap. So talked about a little bit about this early on, but state and local income taxes have been limited to $10,000 under the TCJA. And now that has increased up to 40,000, and that 40,000 will get phased down for taxpayers who make over 500,000, and then gets completely phased out probably around the $600,000 range. So, but they'll still get the $10,000 deduction. Charitable contributions, again, not much change here, but similar to businesses, they've instituted a floor on charitable contributions, so you have to make a certain amount of contributions before they're deductible. The home mortgage interest rules were made permanent, so you're limited to taking interest on the first $750,000 of a home mortgage. And this one's new, car loan interest deduction. This is actually above the line deduction, so it's not an itemized deduction, but it allows you to take a deduction for interest expense paid on the purchase of a new vehicle, essentially. So, and again, there's some rules involved in there, where the vehicle's manufactured and assembled and things like that to make sure it qualifies. So when you're looking at that, make sure it is a qualified vehicle if you want to benefit from that deduction. And then one of the final items, there's the new Trump accounts. These are similar to a lot of tax deferred accounts that are already out there, such as IRAs and things like that. However, there's some different provisions to these. One of the main ones is that the government is going to fund every one of these accounts with $1,000 for everybody that was born between 2025 and 2028. So they'll create accounts, or the individuals can create accounts for the government to make that contribution. And then there'll be different times of which you can withdraw from the accounts for certain purposes. So at age 18, you can take money out for education, to start a new business, things like that. Or in general, if you want to wait, it can also be used as a retirement account. So, and then one final item here. Let's go to the next slide here. Is opportunity zones. So again, these have existed since TCJA, but they're coming back because the current round of opportunity zones was set to expire in 2026. So people that had invested in those zones deferred some capital gains, and those capital gains will have to be recognized in 2026. But starting in 2027, they can invest into new opportunity zones, which will be designated at that point in time. And the setup's a little bit different this time around, where there's this really, you can invest almost in any time, and as long as you hold that investment for 5 years, you'll get a 10% basis step up on your original deferred gain. And the main benefit with the opportunity zones is if you invest in these zones and you hold that investment for at least 10 years, generally there's no tax on the sale of that investment when you sell it. So these zones are designated by the states to try to get investment into areas where that investment may not otherwise come in. So, and then we'll hand it off to Connor.
Yeah, so we can go to the next slide. And this will be pretty quick here. This is kind of, it's not a in one way, it's not a huge change, but another way it was a big deal because the estate tax community was, there was uncertainty. There was the exemption was set to expire at the end of 2025. So, as you imagine, estate planning involves a lot of long-term planning, and so it was difficult to make, plans around whether the estate tax would apply or not, because again, we didn't know what was going to happen after the end of 2025. And under OB3, they permanently, they slightly increased the lifetime exemption, and they made it permanent. And I see we're up on. Oh no, never mind. Energy next.
Yeah, and I will be brief. I think on the surface, the OB3 kind of accelerated the phase out of a lot of the provisions that were made very lucrative by the Inflation Reduction Act. And so in almost all cases, it accelerated the expiration of those credits. And there's a table for your reference later. The theory on what it is actually still promoting in the energy space is domestic energy production. So that's kind of, there's like a change in what's, being kind of promoted. If you go to the next slide, most impactful, I think, in what we see a lot is solar and wind. and electric vehicles, right? So electric vehicle credits are phasing out as soon as this month. And then I think solar and solar credits are phasing out at the end of 2027. And again, with the IRA, they were much more lucrative, were lasting for a lot longer so that investors could plan. So this table is here for reference with the specific credits and when they're phasing out, but on the whole, they're phasing out sooner. And so this can impact some, deeply some developers in this space.
And then just quickly, we've got a link here to an AICPA summary that is very useful. That goes through all of the provisions and changes in OB3. Shows you what the previous law was, what the previous law was, and what the change will be. So it's a good chart to take a look at if you have other questions as well. So I think now we can open it up to maybe a couple questions we might have time for. If there are
Yeah,
any.
we're coming right up on time. I haven't seen
Yeah.
many questions in the chat. One that did come through was how is Vermont provided guidance if they plan to follow these federal changes? And that kind of gets to my broader call to action to folks, which is reach out to us around these changes, how they will affect you and your business, and what you want to see state legislators do about that. But I'll leave it to you folks to talk about Vermont guidance.
Well, unfortunately, we don't really have any guidance yet on how Vermont is going to respond to these. In general, they haven't allowed bonus depreciation, so I think we can assume that they're going to continue not to allow bonus depreciation. They have historically allowed 179. We'll see if they allow the higher limits in that area. In general, Vermont law follows federal law unless there's a specific exemption. So without any other knowledge, we can assume that they'll follow the 174 changes because they did before, but we're not certain on that.
Yeah.
So we'll have to see. They're going to have to come out with some guidance for us and give us some information.
Yeah, just to add on to that, it's because it's an important question in general. As we talk about the federal, but are the states going to conform to that? Most states start with federal, but then they make modifications. And as Steve noted, it's very, very common to not follow bonus. And then other ones are typically follow. For example, 174, most states, it's not a common area for a state modification. Most states tend to follow it. But the big question you'll have to be looking at is state conformity. Some states are a static conformity state, like Vermont. They every year, whenever it comes up, they enact conformity as of a certain date. And then certain states are what's called a rolling conformity state. So they automatically conform to their Internal Revenue Code unless the state takes legislative action to decouple from one provision or the other. So it's an important exercise to look at the states you file it and see, are they going to be following? And I think we're going to have to wait and see.
Austin, you're on mute.
Thank you. That seems like a great place to end it. We're just about 2 minutes over the hour. Thank you all for your participation and our panel for your expertise. As I said before, folks can count on a blog post from the Lake Champlain Chamber next week with a recording of this, these slides and some other resources. But please follow up with us with any questions, comments, and concerns you might have about this content or other things. And I put it in the chat. We're having a great legislative speed networking series throughout the fall and into the winter that will provide you some opportunity to connect with your legislators and talk about some of these issues. So give that a look and register.
Great. Thank you, everyone. Appreciate your time.
Thanks, everyone.
Thank you.